CF benchmarks.
What you're about to hear is a recording of a CF Benchmarks X Space captured live.
Everything on this show is for informational and educational purposes only. It is not investment advice, and nothing we discuss is a recommendation to buy, sell, or hold any asset. The views are our own and do not represent CF Benchmarks, Kraken, or any affiliated firm. Any price targets, valuations, or models we mention are illustrative and not forecasts. The participants and their firms may hold positions in the assets discussed. Digital assets are volatile and you can lose your entire investment. And some products we reference may not be available in your region. Always do your own research and consult a qualified financial advisor before making any decision.
Good morning and welcome back to another CFB Talks Digital Assets Live. My name is Gabe Selby. I'm the head of research at CF Benchmarks. With me, as always, we have Mark Pilipczuk and Tomas Perfumo. And this week we're joined by the boss man himself, our CEO, Sui Chung. Welcome, Sui. Good to have you back.
Thanks very much, Gabe. It's great to be here on what has been a pretty tumultuous 24 hours for the digital asset class. So yeah, really looking forward to digging in and hearing what much smarter guys than myself, like you guys, have to say about what's been happening, what's precipitated it, and what we can expect.
Yes, a lot to cover. And I'm not sure about the second part, but we will do our best we can to cover as much as we can. And as you were mentioning, Sui, we have Bitcoin, of course, soaring right now after the US Treasury announced that they were going to increase their intervention measures and purchase at least $4 billion a month of long-dated treasuries going forward. And also we are seeing just a lot of, I think, mixed signals here within the equity market space. And we're jumping into a week that's going to be headlined by the Fed and Jackson Hole. So we'll talk about that. But before we do have some major news. The CME and CF Benchmarks have just announced not one, but two major new indices. The CME CF Crypto Market Index and the CME CF Emerging Crypto Index. So starting on August 31st, the CME is going to add two multi-token cryptocurrency indices that will include both real-time tracking, London, New York, and APAC settlement variants for each. And we're going to go into that, I think, right off the top here with you, Sui. So with the first question that I want to open things up with to you is why did we, what was the vision here on launching both a definitive, market measure index through the CMI, and then also couple that with something like the emerging crypto index that's a little bit more, I wouldn't say like an altcoin index, but, looking at kind of these emerging leaders in the blockchain space?
Yeah, thanks for that, Gabe. Yeah, good question, and I think there's one it's certainly on a lot of people's lips. The way we look at the asset class, as I'm sure your regular listeners will know, is that we think of it as an asset class, and we're always seeking to capture the returns of individual tokens through our benchmarks and the market at large through portfolio benchmark measures such as the CMI. And the CMI is just that. It captures the broad market. It does so, though, however, with what I would claim is a little bit more intelligence than just a pure market cap index, because we do have certain selection criteria, in particular that software protocols that are associated with token asset fit. So that means they have TBL, they are utilized by their chains, they're utilized by protocols that actually have actual activity, that there's TBL there. So they've demonstrated a certain degree of market fit. Because as we know, there are many, many token projects out there. We're not here to judge the merits of them, but what can be seen through blockchain analytics is just how much utilization there is. So we built the crypto market index, and as anyone who follows the crypto markets knows, that if you take the asset class in market cap terms is dominated by the two major assets, Bitcoin and Ether. And so if you look at the crypto market index, it is large chunks of the weight go to Bitcoin and Ether, as they should, because it is a market measure, a measure of the entire asset class. But obviously, if we look at the reality of investment today and the access vehicles available to investors, and where capital has flowed into in the asset class, that is predominantly in Bitcoin and Ether. And so you have many investors who already have exposures to Bitcoin and Ether. And so a broad market cap measure isn't going to be very useful for them from an allocation perspective. Being bizarre, we recognized, and so devised the emerging crypto index, which is the crypto market index excluding Bitcoin and Ether. So it has the same rules. All the assets to be eligible do have to demonstrate product market fit. They have to have TVL, they have to have utilization. So they are the emerging leaders within the asset class. They obviously haven't reached the investor recognition and maturity of Bitcoin and Ether, but these are the assets, and the way the rules are set up is to capture the assets that hopefully will be joining the Bitcoin and Ethers of this world in the fullness of time. Because obviously it's a rules-based index, so it's not a static portfolio. It will reconstitute and rebalance every 6 months. And really that's the reason, that's the aim for having these two separate indices, so that the investment and allocation community have something to measure the market's performance by, as well as an index that could be better utilized for allocation purposes.
Perfect. Yeah. So looking at the two offerings, it's clear that when you consider the market structure of digital assets, of cryptocurrencies, and this is very analogous to Bitcoin as a single token. You have to kind of be a little bit more creative. Yeah, it's not as straightforward as maybe benchmarking a traditional asset class. There's certain I think additional methodologies you have to implement and construct in order to kind of create, I think, an index product that's going to give investors, the best outcome possible for measuring these types of things. And so I want to first maybe double click on CMI and talk a little bit more about that with you. So the crypto market index, it selects the top 12 eligible assets from a scalable universe. And we of course see that breakdown in the portfolio weighting. Can you just give the audience kind of a high level overview of how we define the market, quote unquote, and how we are able to kind of separate overall breadth of tokens with a free float market structure versus like using something like an equal weighting structure? How do we get there with the current selection criteria?
Yeah, of course, Gabe. So, we start with the investable universe of tokens, just as in equities and fixed income. First, you have to define what the investable universe is. So the investable universe, as far as CFB is concerned, and we've been consistent on this, is over the years, is that it's got to be an asset that's listed for trading against the US dollar. And I think that's pretty key. Listed for trading against the US dollar on secondary markets operated by crypto exchanges that meet our constituent exchange criteria. So that means they have sufficient volume. That means they hold regulatory permissions to allow them to offer their services in the major jurisdictions of the world. We operate a global business. We have licensees all over the world. So we have to make sure that all market participants can actually access a token. That's the definition of its investability, right? So investable universe starts there. once you've got all those tokens that have listings on 2 or more CME, CF constituent exchanges against the US dollar, you've got a couple of, about 1,000 tokens, in fact, that meet that criteria. Then what we do is we rank them by their free float, by their full market cap, so that you've got clearly Bitcoin at the top as occupying the most market cap, and then stack rank them with their market caps. Now, if you sum all the market caps of all those tokens, you get a total market cap, and so you will be able to see what percentile of the total market cap that each token, when you stack rank them, represents. So Bitcoin is about 70% of the investable market cap, then Ether running up to close to 20, etc., and you can come down all the way right to the bottom to the 1,000th token, and that would get you to 100. And what the CMI does is it cuts off at the 99th percentile, because what we want is enough of representation of crypto market cap that if you held that portfolio, you would by and large get the returns of the asset class without having to hold 1,000 tokens, because there's a degree of efficiency that you're looking for. You want to replicate market performance as efficiently as possible, so that and the practicalities of liquidity and the practicalities of running a portfolio have also meant that we've applied a cap. Right now, given the way that the crypto market cap is distributed today, we don't actually necessarily need to use that cap. With 12 tokens, you get to the 99th percentile. So that's the universe that we're capturing. And then the assets are just weighted by free float market cap. They're not equally weighted. Equal weight is one. It's called equal weight, but in effect, when you equal weight a portfolio, what you're doing is you're upweighting the small caps by definition, because in any portfolio, typically there'll be some constituents that have a higher market cap, larger market cap than others. And by equal weighting it, you're basically saying, I'm going to ignore the market cap of the constituents and they're all going to get equal weight, which is basically upweighting the small caps. Now, for a measure of the crypto market, which is what the CMI, the crypto market index, is intended to do, we don't think that's appropriate, because you're going to get the returns of an equally weighted portfolio will be relative to market returns will be skewed towards the small caps.
Yes, to me, this is taking me back a little bit to my over 10 years ago now of studying for these CFA exams and learning about this exercise of stratified sampling to create portfolios. Essentially, you find an asset class that's very difficult to fully invest in. And in this case, in the boring textbooks of the CFA Institute, it'd sample things like high yield credit or some sort of corporate bond universe, and somehow create and construct a portfolio index that can basically give you a beta of the broader market. And that's what this is with the CMI. It's basically giving you the S&P 500 exposure, a broad-based measure of reality for the crypto market, but doing it so in a much more efficient way that can minimize the liquidity concerns that you have with smaller tokens and the turnover impacts of tokens, rising and falling. So I think that'd be kind of where I want to go next, is kind of talk about some of these guardrails that the CMI has, which is very unique if you compare maybe some of these other indices that are also trying to do what we say we're doing. How do we safeguard against churn? How do we protect investors from negative outcomes in some of the dynamics that you typically find in this asset class?
Yeah, Gabe. We're always guided by the reality that this is still a very young asset class. So, we want to obviously borrow as much as possible from existing investment and portfolio theory and the tried and tested methods that have been used for indexing equities, fixed income, and other asset classes. But at the same time, we need to recognize that this is a very nascent asset class, relatively immature, has some unique dynamics to it. And hence, we've applied a series of extra rules, basically, to determine eligibility of assets. As I mentioned, we're looking for a degree of maturity of not so much the asset, but actually the software protocol that's associated with that asset. As we all know, each token that's out there has an associated software protocol, be it a blockchain, be it a dApp, be it a service protocol like an Oracle. So what we want, one of the key rules that we apply is that the software protocols have to exhibit a degree of maturity, i.e., they have to have a degree of utilization and a degree of utilization that is relative to the token's market cap. And so that is designed to ensure that the tokens inside the portfolio are associated with effectively productive software protocols, productive blockchain protocols that have utilization, that have TVL. TVL is the primary way we measure this, like total value locked. And that shows us that there is actual economic activity happening through utilization of this blockchain software. And that's there because, again, the asset class is very immature. There are many projects. Now, some projects obviously are very ambitious, so they take longer to find product market fit. Some are less ambitious and have a very focused objective and achieve product market fit. But we're not judging that. We're just judging all we're doing is seeing if a degree of product market fit has been achieved. And that, obviously, from an investor outcome perspective, is to ensure that investors are getting the exposure that they're seeking. Because, when investors allocate to tokens and crypto assets, cryptocurrencies, by and large, they're expressing a view that blockchain usage, particularly public blockchain usage, will grow, and the economic value will accrue to those blockchain software protocols, blockchain networks, and hence the tokens will appreciate in value, right? Because often the token is the currency of a blockchain network, or is the governance mechanism by which software protocols are governed, and hence they will appreciate value. So it all ties back to that question. So I think that's probably the rule that is, that's probably the rule that we have for this index that's very different. You don't find that type of rule typically in an index, but it kind of but if you cycle back, it kind of does exist, right? Because if you think about equity indices, if you think about the S&P 500, to be a constituent of the S&P 500 is, the shares of companies that are listed and are, one of the 500 largest of the US equity markets. That very act of being a listed company and becoming one of the 500 largest, obviously, to be able to do that, you need a company with revenues. Revenues mean there are customers using the products and services that the company produces. And so our product market fit rule for crypto assets, it really sort of seeks to mimic that sort of analog. That analog does not exist in crypto assets. There are no qualifying criteria for the listing of tokens, etc., etc. So effectively, as the index provider, we're having to devise that analogous rule to ensure that the portfolio that the index determines is one that is going to be helpful for measuring the market in a durable manner, and an index that allocators can use to allocate into the asset class.
So one of the things that we've consistently seen in this bear market with price action is a selectivity bias towards these protocols that have product market fit. If you think about like a token like Hyperliquid, if you think about tokens like Aave, Uniswap, these are blockchains. These are protocols that have actual real customers every day showing up, transacting on it, use cases, and certainly I would say represent the potential of what this type of technology can do in the real world and what it can disrupt for the financial markets and industries. I think it's very thoughtful the way this index has applied that distinction and that filter overlay to kind of generate a measure of this asset class, which, let's face it, historically has had a lot of let's say like ghost chains or protocols that do not have any sort of meaningful use cases. And certainly, I think, I'm not trying to say that, people should or should not invest in things like meme coins or stuff like that. By all means, if that's what you're into. But I think when we talk about, creating these institutional grade benchmarks, that's something that's pretty important. So that's what I kind of wanted to say there with that. I do want to turn the page and talk and bring in the ECI now. Since it is also the second index that's launching today. In summary, just as a first bullet point, it excludes Bitcoin and Ether, but it still keeps these tests for liquidity. It keeps these tests for turnover, exchange assets, custody size, distinctiveness, product market fit, classification, all these other listing standards that we've been talking about. Why should this be considered established leadership beyond kind of like the core offering, which is the CMI, rather than like a broad altcoin basket that's being launched with the CMI?
Yeah, as I mentioned at the top of the show, the motivation here is very much operational, practical implementation. The reality is that in institutional and traditional investor allocations, Bitcoin and Ether may already, many allocators have already allocated some portion of capital, some part of the portfolio to Bitcoin and or Ether. And that means that if an investor wishes to go beyond that, you don't necessarily want to create the churn, right? You don't necessarily want to be pushing investors to say, oh, okay, you've got your Bitcoin, your Ether, sell that and buy into a vehicle that invests into the crypto market index. A bit like today, if you in the equity markets in Apple, or the S&P 500, but they probably wouldn't recommend that you actually sell those two positions and replace it because of the cost of doing so, potential tax implications, etc., etc., etc. So, hence we launched the ECI, which is the CMI just more than Ether, because there are many investors out there who already have Bitcoins. If they wish to broaden out their allocation to the crypto asset class, and the ECI becomes a very convenient means to do so, because you maintain your Bitcoin and Ether holdings, and then you size up your ECI allocation, your allocation to the emerging crypto index, and voila, there you go. So that I think that's one primary reason we're seeking to address the investor base out there that is already allocated to Bitcoin and Ether. I think the second piece to remember is that when you take of the CMI, you have the other coins there. The way they behave is quite interesting. They effectively no different from other asset classes. When you remove largest constituents from consideration, you get a profile, a return profile that is effectively more concentrated, right? And in the case of crypto assets, that means what are the essences of crypto assets in terms of performance? Well, volatility, asymmetric returns, etc. And then what you find with the ECI, at least historically, is that it exhibits higher volatility. It has higher peaks, lower troughs. And so as part of a broader portfolio across asset classes, you're getting a more distilled version, if you like, of the crypto asset class proposition. And so can be used too.
Is it fair to say that this is could be considered the satellite sleeve to the core offering?
Yeah, totally. And the other great thing with the I was going to say, I think it totally could. I mean, if you take a look at just the strip Bitcoin and Ether out of the market and take a look at our CMI constituents, and you look at what percentage of the TVL and the fees and the users in our investable universe the ECI actually covers, it covers over 75% of all the fees generated on chain in our investable universe over the last year, with just a small number of constituents. The TVL, it's around 20%, and that's because most of the TVL that exists out there in the world is on Ether right now. But you still get pretty good coverage without having Bitcoin and Ether in there. Same thing with active users. You see that number hovering around 50%. So if you already have a position, maybe you're an allocator that added Bitcoin to your portfolio or to your model a year or two ago, and you're looking to gain some exposure to the rest of the space, and you believe that fees or that users are ultimately where the value is going to come from, you can add this index in a small allocation or add a portfolio that's tracking this in a small allocation to your total portfolio and capture about 70% of the fees generated and half the active users on chain.
Yeah, just real quick, Mark, just to follow up on that. Who are some of these leaders that you're talking about when you look at the fundamental breakdown of the universe?
Yeah, so the notable leader in fees there are going to be your DeFi protocols, your Hyperliquid, your Aave, your Uniswap, with Hyperliquid really driving a lot of those fees. If you look at where a lot of the user activity is, that's going to be more on the BNB chain, the Binance Smart Chain is where we've seen a lot of activity there. So that's kind of, and same with the TVL. A lot of that other TVL is coming from BNB. But yeah, a lot of the fees are in the DeFi space, and then TVL and users are on some of those alternate layer ones that you're getting exposure to.
Perfect. So yeah, I want to ask maybe just one more question on these two indices. They're anticipated to launch. We just announced this today, but they're anticipated to launch on August 31st. We talked about the different variants: New York, APAC, London, and we're gonna also have a real-time index. So if you have a Bloomberg terminal, you can track the markets live. You'll have the core sleeve with the CMI, the satellites, or the satellite sleeve here with the ECI. I just want to get your take. You're the CEO. Why now? Why is the timing for these indices to launch now?
Yeah, the great question, Gabe, and it's not it's not that we've only just found it. We've been working on this for a while, but what we wanted to see for launches these indices, we wanted to see the regulatory landscape for the major AX vehicles for crypto really solidify, and we've seen the SEC has done a lot of work on what crypto assets are eligible to be wrapped into ETFs, and they've extended out that definition such that more assets have become eligible. The same is true of stock exchanges in Asia and rules in Europe. And so that's been the main drive. We don't look they're only worth launching if they're going to have practical utility for investors, and the practical utility they have for investors is on the rise. More regulators around the world are more comfortable with more crypto assets being eligible to be held by investment vehicles, investment funds, ETFs, ETPs, etc., etc. So that's why the timing is now. And I also think that, we've been quite fortunate in that we've been able to observe how the market has behaved, how the asset class has behaved over almost 10 years now. CFB is almost 10 years old. So a number of cycles, and be able to learn the lessons of those cycles and distill them at these indices at a time, when regulatory clarity is really beginning to crystallize.
Oh, that's awesome. Perfect. No, it's everyone bookmark your calendars. The launch is happening soon, August 31st. We'll be following it closely. Thank you, Sui, for the takes there. And please stick around if you can. We're going to jump over to the next segments that we have lined up for the hour. A lot is happening in markets right now. I mean, it's like I don't even know exactly where to start, but basically, we saw the US Treasury announce that they're going to increase their monthly purchases of longer dated Treasury bonds to help support liquidity and basically help support prices, which inversely correlates with yields. Now, what's happened, in the past 24 hours is pretty phenomenal in the sense that the 10-year Treasury, which I think started the week around let's say 5.31%, and then fell, precipitously down to 5.18% after the Wednesday buyback announcement, has now officially crept back and crossed the Scott Bessent put. So Scott Bessent is being asked to go buy the investors' bonds, and the bond buyers are striking. This has transpired into a pretty significant catalyst, as we can see on the Bitcoin price chart. I've got the Bitcoin price chart here coming from Kraken. It is up trading at 72,418 at the time of this recording. We're seeing heavy volume, heavy bidding. We look at the IBIT ETF. It's got a huge gap up from yesterday's close to today's open. Very indicative of strong opening buying is when you see these kind of opening gaps with these types of products. I want to bring in our chief economist from Kraken, our sister company, and start getting his takes. When a $4 billion operation announcement cannot hold the long end for one session, as we saw just now, what do you think is going to matter more? Smaller coupon auctions, more bill or short coupon issuance, or does the Fed ultimately need to step in under a completely separate mandate?
Oh boy. I think the mechanics of it, I don't know how it's going to play out, to be honest. I think the short-term bet that it seems like the trading community is making right now is that this program announcement isn't going to change the overall direction or the wind pattern of the problems that the credit market is facing right now. But I think the signal for the market is all the more important because it's pretty clearly identifying that the head of the US Treasury, who's the one who is trying to deal with the budgeting and trying to deal with the financing of the country at large, is basically telling you that the interest rates where they are today are at a stress point, and that he's going to take extraordinary actions to try to tamper it down. And so I think that's the main signal. And the trading game right now is trying to understand, like, is this enough? Is he kind of bluffing? Or do we need to see more intervention before we start to really believe him? That's sort of the spot we're in. With crypto, it's a bit of a different story, because I think there was so much asymmetry priced out that you wouldn't get any form of intervention or QE absent a crisis event, because of a lot of the rhetoric from like Kevin Warsh, for example, that he believes that the balance sheet's too large, that this kind of event or something akin to it is not even on the books. And to see this come out, I think for an asset like crypto, resurrects a lot of that kind of call it low probability but high expected value contribution. And so you're seeing a lot more reflexive positive outcome on that asset class versus the credit market, where they're being a little bit more testy, I think.
The 4 billion, at least $4 billion number was very interesting to me. It's like my brain immediately like picked up on that, and like you were saying, it's clearly, I mean, it's not going to be enough, and I kind of came to that conclusion right when I read that, and I'm in some ways not surprised that we've seen such a turnaround so fast with these round tripping yields, given the fact of where the fiscal, I would say the fiscal path of the U.S. is going. I mean, you look at the interest expense alone this year, we're projected to have like $1 trillion just covering the interest payments on a economy that I think is about, I'm not sure what is it, our total GDP is around 8 trillion right now, or no, I'm sorry, that's not the total GDP, but that's, I think, the total revenues that the U.S. government takes in from taxes, or yeah. So and so I think that the size of this is pretty significant, is pretty insignificant, and when you compare it to these numbers that we're seeing, around the clock, it's kind of mind-boggling to me that Mr. Bessent kind of thought that this could potentially work. It did buy some time. The market reaction is clearly the thing to pay attention to if you look at the Bitcoin relative outperformance. But not only that, but you have also just cryptos in general outperforming. Meanwhile, if you look at the long duration equity cohorts, you think about the big tech names, these have been fundamentally trading on the AI story and the exceptional earnings season. But if you look at the NASDAQ, it's down another 0.7% today. That's clearly not mattering right now, the duration story of traditional higher tech, longer duration equities. So to me, this is a pretty significant catalyst. It could be for Bitcoin, for digital assets, and we're gonna have to wait and see. But let's go ahead and get some other folks' take here. Mark, what did you make of the announcement, and what are you seeing right now on your screens?
Yeah, so for me, the whole thing with the announcement is we kind of know the stress level at what point the interest rate is they're too high that they're going to step in. That's mainly what that tells us. That doesn't really tell us too much of the extent of what they're going to do. I was looking at some elasticity analysis the New York Fed did in probably February of 2026, and they looked at it. If you wanted to move the 10-year by 6 basis points, you'd have to do about $100 billion in buying. So that 4 billion number isn't even close to what it would take to move the yields down materially. Because with the 10-year over 4.7 now, I mean, Bessent's thing was 3.33. He wants that at 3%. If you have to move it down 170 basis points, that's trillions of dollars. That's trillions of dollars that you're going to have to buy. So 4 billion isn't really going to move the needle there. We at least know now what levels kind of they deem too high, and we'll probably have to see what the Fed says about this. I know Warsh has a task force out there on the balance sheet. My suspicion of that task force will conclude that they need to expand the balance sheet and they can't shrink it, because if they were to shrink the balance sheet or do any runoff or anything, then you send yields even higher. The other thing I really paid attention to yesterday was there was a White House crypto summit where they talked a little bit about regulations. We saw our very own president mention Hyperliquid by name in that. Got a nice 20% move on the news. It looks like the CFTC and the SEC, though, are looking to go ahead and start to put in place some regulatory frameworks, even if they're ultimately temporary, while we wait on the Clarity Act. So there is also that positive regulatory catalyst and some real engagement there. And who knows, maybe this does move the Clarity Act odds up in September a little bit, but I haven't really looked too much at that.
Yeah, so I think we just got you back. I'd be curious to get your take on what's happening here in the U.S. markets. One thing that I'll briefly mention is that this burden, the step burden that we're seeing across sovereigns is happening across the globe. If you look at Japan, it's a global story, a global phenomenon. From where you sit over in the UK, what's your take, over there as far as how do you see their fiscal situation evolving, and how does it compare maybe to the US, what you're seeing over here? I think we can, or we still don't have you yet, Sui. Sorry. All right. Well, we'll continue to work. Oh, Sui, can you hear us now? Hello, Sui.
I still see him as a listener.
Okay.
Yeah, I sent him another invite to speak here.
Yeah, we'll get him back on here and get his take on that. So yeah, with regards to digital assets, let's look at the Bitcoin price chart. I kind of want to talk about some key levels. Tomas, you've been following a lot of these moving averages. I know you talk about it with very closely with the VIP clients that Kraken has. How sizable is this move? Are you seeing any sort of key levels start to break that can kind of get us maybe a confirmation on a new sequence here in this market structure?
Yeah, I mean, I think so. First off, the level that for the last several weeks, probably like 2 months actually, that we've been calling out or talking about quite a bit has been the 200-week moving average, which is closer to like 63,000. And that has been the support level that everyone's been kind of underwriting against for having exposure on. I saw some feedback yesterday of people looking at shorter-term moving averages, less than a year, where you had some resistance around the 69,000 level, and we've obviously broken through that overnight. Here's kind of how I view the move. If you're an active trader, of course, you can kind of play these games around moving averages and try to identify resistance and whatnot. I think the important thing with Bitcoin right now is you have to really respect that there is a lot of reflexivity built into it. That is to say, there are reasons to believe that as performance improves, that you can get a positive feedback loop. So, for example, yesterday was the second best day of the year in terms of return profile. A lot of people have been looking forward to it, to a day like that, and it gets kind of that bullish spirit up. If we start to see ETF flows pick up, where in this price range has been some of the best buying activity that we've seen year to date, not so much the 60s, but actually the 70s, because you have momentum behind it, you could see another kind of follow through run up. Likewise, if Bitcoin starts to perform really well going into the Clarity Act, and you have a whole bunch of people at the grassroots level buying it again, guess who's going to be calling their senators? Right, you kind of build this momentum game. So when I think about levels, of course, I think if you're a short-term active trader, it's something to consider. If you're someone that has a little bit of a long-term horizon and you're playing in this market, I think there is a respect of reflexivity, don't fight the bull kind of mantra that tends to pick up these markets.
Yeah, real quick, I just want to correct a couple numbers I said earlier. So federal revenue for the U.S., the full year 2026 estimate is to come in at 5.6 trillion against federal outlays and spending to be projected at 7.4 trillion, giving you a budget deficit of approximately 2 trillion. Current net interest expense is projected to be 1 trillion. Of course, we've seen how the fiscal balance has come in on months. It's been actually larger and I guess surprising to the upside, meaning that the U.S. is spending more than what we've projected, and the CBO is projected for their baseline. So what that translates to is we have an economy that is roughly around $32 trillion. And the interest on the debt is becoming almost, over a majority, basically, of the budget deficit. And I think the scary part is when we get to a world where interest expense on our debt is basically, greater than what would have been just the deficit itself, which is where we're heading right now. And that's where we get into those debt spirals that some of these prominent I would say perma bears talk about. So it's very telling to me, and I like your take here on the technicals. Bitcoin at 72,000 does look very bullish. For me, if I look at a daily candlestick chart, I do want to see us close above 73,200, which would bring us back to the May 31st close. And then we, of course, had that June 1st dump on Bitcoin prices, which kind of brought us into that consolidation zone. But the thing is that you have to remember with markets, particularly with Bitcoin, over time and time again, you need to find catalysts to create that reflexivity, right? So in late 2024, one catalyst was that the U.S. political presidential election, and the year earlier before that year, we had the U.S. spot ETFs launch. Once you get these catalysts, once you start seeing that higher volume bids, the imbalances that it creates on the price chart, these are kind of the signals that you look for like a real market structure regime change to go from bearish to bullish. So it's still TBD for confirmation to see if we can cross over and get a new structure going. There's going to be pullbacks in the short term. Of course, there always are. But I like what I'm seeing on the chart right now. I mean, how can you not? This is something that we haven't seen, I don't know, since probably like, I'd say summer of 2025, maybe. We kind of had a lot of lower volume price action there. So yeah, no, this is it's exciting times. Mark, what about you? What are some key levels that you're seeing for Bitcoin?
Yeah, my main level I'm kind of watching at this point is we created a pretty big fair value gap right there on the initial drop in late May, probably about 73 to 62K is kind of where I've got it. So I'd like to see us clear that 74,000 level and turn that into a new support before we could potentially move a little higher. And we also have some more resistance areas above that too, kind of some fair value gaps in the 80 to 90K range from back in late January when we got that first sell-off. So we're not totally out of the woods yet. We still have some pretty heavy resistance that we'll likely be coming into. But when you see a good day like this, where you get a nice 7% move followed up by another few percent the next day, that's what you want to see. Also watching Ether. Ether is kind of coming towards the top of the fair value gap it created way back last May when BitMine started buying a whole bunch of it. Kind of that 1,800 to 2,500 level it's sitting in right now. It's also been interesting. That got a really nice move yesterday on some of the proposed regulatory clarity and some of the market structure commentary that was coming out in the afternoon. That's where it got a second leg higher. So yeah, really, really watching those catalysts there. And when I look at things, our biggest potential catalyst is still regulatory clarity, not necessarily the monetary or fiscal policy, in my opinion. What I'm watching is the reaction of tokens to that potential for regulatory clarity, even just a little bit yesterday, because those are likely to be the leaders when we get the real deal, whether it be a bill or the final guidance out of the SEC, or we start seeing the CFTC allow some of these markets to open up to U.S. and U.S. institutions.
That makes sense. Look, I think we're moving through the hour pretty quickly. Yesterday we got the Fed minutes. Guys, anything that we want to highlight in that, or was it just kind of let's just say kind of a snoozer, or what we largely expected to be in there?
I'll jump in with some highlights, I suppose. I think broadly snoozer. I didn't find there to be too much of interesting read-throughs. I was doing a comparison against prior meeting minutes for earlier this year, And it seems like everyone's kind of like a blade of grass moving with the wind on the labor market weakness, and people are acknowledging that it's been a bit soft as of late versus earlier this year. I saw some commentary around, particularly like headlines from press around the, more participants are suggesting that policy tightening may make sense. I think the language that they used in the minutes were that many participants assessed that policy tightening would likely be necessary if inflation did not decline. And of course, with the recent inflation data points, we haven't seen the progression of inflation accelerating higher. So I think that's kind of a nothing burger. The one thing that I did want to highlight that is interesting is this ongoing trend of an increased importance placed on this AI narrative. Everyone seems to be continuing to talk about that they don't see any meaningful impact anecdotally or in the numbers of AI in the short run on employment, to the downside at least. But they are starting to talk up more and more that they're anecdotally and in some cases seeing some read-through of AI spend impacting consumer inflation, for example, smartphones and whatnot. And one of the things I did was I took a look at the count of the keywords AI or artificial intelligence showing up in meeting minutes since during 2026. And this last meeting, it showed up 26 times. The meeting before in June was 20 times. And the next highest was 11 times in March. So I'm just mentioning this as something that I brought up in the newsletter a few weeks ago. This trend of growth of talking about AI, particularly in the context of consumer inflation, there's clearly a little bit of concern here that people are seeing a reason or a read-through of CapEx spending leading into some areas of consumer price inflation, particularly on the electronic side, although at the same time, it doesn't make up a massive contribution of the CPI. So the only other thing I'll add here is that there was some discussion in the minutes that seemed to indicate that people were interested in kind of leaving rates where they were because they were going to get 2 months of time in the intermeeting period to assess the damage or the ongoing situation with Iran. And there was a discussion apparently about reducing the number of meetings on an annual basis, perhaps as early as next year, not this year, with the intention of increasing the amount of time between meetings for this reason. So just very interesting or small interesting tidbits on the margin, but nothing that really moved the needle in my opinion.
I think we're definitely due for some rotation in the AI names. If you think about, what's directly in front of them, well, we know that there's more and more news about companies reevaluating their budgets on token expenditures and putting in, increasing oversight measures to cap that or reduce that. And that's going to trickle through from these AI providers, your OpenAIs, Anthropics, into the hyperscalers, into the infrastructure play. At the same time, this story about rising treasury yields is basically not just a dynamic of higher, borrowing costs or higher discount rates. It's also creating a crowd out effect because of the fact that the U.S. has to issue out more supply, more debt issuance at higher yields that investors can start to kind of rotate to and start to look to as an attractive, opportunity without actually maybe even moving the needle on compressing the yields because of the supply so big. If you look at the municipal bond market, it's on track to be another gangbuster of issuance. So there's debt supply coming on the markets at the local and federal levels. That's going to, I think, have a lot of dynamics. And then you have to kind of just zoom out and say, okay, where are we finding discounts in the market? Where do we have theses? Crypto certainly has been a laggard for so long. Now is the time to maybe consider, rotating back in, that you've got the 50% plus drawdown in these names. And you also have the catalyst of what could be, a serious fiscal situation happening in the world's largest economy. Sui did drop off. He had these technical gremlins, unfortunately. So I will share with the audience a quote that he just messaged us with when it comes to the treasury purchases that we're seeing. And it's kind of funny. It's from the novel Oliver Twist, Charles Dickinson, of course, famous novel where the boy is standing there saying, "Sir, can I please have some more? Please, sir, can I have some more?" I'll do my best with a British accent. Um, that pretty much, I think, sums up what the market is saying. Is Mr. Bessent, I think you need to keep buying some more bonds right now. So I think it's not working, sir. We need some more gunpowder. So thank you, Sui, for that tidbit. He always brings the extra color. I can say that after working with him for over 4 years. So we've got a few minutes left. I can't ignore what's coming up around the corner, which is the Jackson Hole Symposium. Gentlemen, what do you think? What do you think Kevin Warsh is going to say when he gets up on the podium there in Wyoming?
I think he's going to say, if you want to know more about US Treasury buybacks, ask Conference. Because that's going to be the biggest question he's going to get now, is about this facility and how the Fed is going to work together with the Treasury in some way, shape, or form. And I think he's going to say a whole lot of nothing.
Yeah, somebody needs to do the meme where you've got the Spider-Man characters just pointing back to each other. It's basically Scott and Kevin.
Exactly. So yeah, I think it's going to be a lot of that. I don't know. Like I said last time, the only interesting thing that I think might be a surprise would be if he started bringing up any findings from the task forces, which again, my expectation is that we won't hear anything for another couple of months because he just started them, call it a month and a half ago. So staffed them a month ago, maybe. But if he starts sharing any of the findings or early discussions from that, that'd be interesting. Otherwise, if he has any emerging thoughts about the labor market or I guess just interesting thoughts around inflation itself, like sources and of inflationary effects or areas where he's seeing some softness. But I struggle to find I struggle to have like a high conviction that he's going to say anything interesting about almost anything on Fed policy.
Mark, I know you're excited about the task force too, especially the balance sheet one, right? What do you think he's going to go there?
I suspect that he's very much going to stick to the script on payments and payments innovation, and I don't think we're going to hear too much about the task force or their findings here, because I know he's not big on trying to give forward guidance or giving the illusion of forward guidance. At this point, with all the landmines and the data that are coming out and everything that we're watching for, anything could potentially be read as forward guidance by the market. I don't think he's going to give the market an inch here.
Yeah. One more thing on the meeting minutes that I wanted to raise, because I was just thinking about this when you mentioned the task force. There was one paragraph or two sentences I found very interesting. It said, most participants commented on balance sheet policy. They noted that the findings of the task force on balance sheet policy would be useful input into committee deliberations and suggested that future FOMC meetings would provide an opportunity for a comprehensive discussion on the topic. And so what I find interesting about it is that even the committee, the FOMC itself, seems to be hungry to get deeper on this topic in the near term. So I don't think he's going to be ready to talk about anything publicly. That's why I have low expectations for it. But I do think he is actually also getting some pressure internally that they want to talk about it.
So, I mean, I just really would not want to be in his position right now. I mean, this is just looking, I think, rather complicated with the current picture with inflation. Not accelerating like you said, Tomas, but also just really staying somewhat stubbornly elevated. And then what we have going on in treasury markets, I think. I would agree with Mark. He's not going to give you any probably forward guidance yet. Although I do feel like the forward guidance blacklist that he's imposed is really kind of a cover up to buy him time for financial conditions, for the markets to kind of begin to rotate to be more dovish. I mean, this is a person that was elected by our commander in chief, who is very vocal about lowering interest rates, and I think he knows probably the wrath that would ensue if he were to start providing forward guidance that was appropriate for maybe the situation that they were facing a few months ago when he entered the job, and that would be to raise or hike interest rates, but has chosen to defer that view, and I think that's bought him some time. So perhaps the cracks in the sovereign market's something that he could use to rotate that guidance and step in and say, okay, we need to start providing some stability into the markets. We need to start providing some sort of read to get this under control, because ultimately, the Treasury has its abilities to fight this, but it will come down to the money printer, to the issuer of the currency, and that is the Federal Reserve. So, Bessent can't do it alone. It's going to take more. I think that's where I feel about this. It can't just end with the Treasury, and whether Kevin Warsh's prior views of reducing the Fed balance sheet still persist today or not. I think he's going to have to maybe come to recognize that now might not be the time, given what's happening with the current fiscal situation of the country. So, yeah, it's going to be interesting. I think we're going to have to keep this conversation going each week. But let's go ahead and start wrapping things up since we're on time. What's top of mind for the next week ahead, gentlemen? Who wants to go first?
Yeah, here I'll go up. So yeah, in addition to Jackson Hole here, that's kind of my main one. We have the July PCE landing, late next week. So we'll see. We'll take a look at that to get a picture of the inflation picture. I'm going to be very interested in fund flows over the next 7 days, the breakdown between Bitcoin, Ether, as well as broader market and altcoin funds after the most recent move. And I'm also going to be watching stretch in what happens with MicroStrategy here as the Bitcoin price recovers.
Yeah, I'll jump in. Yeah, on the economic data side, PC I think is a good one next week, but I will also mention that because CPI and PPI have already been out, like I don't anticipate you're going to get any really surprising information there. Jackson Hole, of course, but also I think it's going to be probably a snooze. I agree with Mark. Actually, top priority for me is seeing the follow through on flows, because like I mentioned before, if you look at the net buying activity from Bitcoin ETFs, whether it's number of trading sessions or the dollar amount, these price ranges tend to be like fulcrum points. Not as much the low 60s, or excuse me, not as much the 60s or the 80s, but actually the 70s, where you've seen an influx of buyers coming in, and we're seeing it at a time when, or we're seeing this bid at a time when the tech and semiconductor stocks are a little bit more choppy, and so the competition for these flows, I think, may favor crypto. For Ether, if we get a breakout above 2450, I think that's a big deal. That's the 200-week moving average for Ether. It hasn't been able to break through that since January. So those are the things that I care about most.
I would echo all of those. Those are really good answers, as always. One thing I'll just highlight, since it's been the topic of the hour, is or one of the topics of the hours, but it's been pretty significant and top of mind for a lot of investors lately, is the upcoming auctions that we have. So on Monday, August 24th, we're going to get the 13-week and 26-week bills, short-term paper hitting the tape. Be sure to kind of keep an eye out on that. The most sizable one is happening on Wednesday, August 26th, is the 5-year note, $70 billion coming out on that auction. And then we'll follow that up on Thursday with a 7-year note, $44 billion. And yeah, just kind of keep an eye on the metrics, bid to cover ratios, the tails, all the usual stuff. See how this stuff is being absorbed in real time. It's going to be probably closely followed by the media, and I'll also be sure to bookmark it as well. So with that, I think that wraps up the hour. Thank you all for participating, and thank you to the audience for joining. It's always a pleasure to talk markets and macro with you all. As always, do your own research and be sure to trade safe. Until next week, see you all. Thanks.
Thanks.